All right, so in the next 5 or 10 minutes here, we're just going to kind of walk through and give you a brief overview of this spreadsheet, which we call our sample break-even budget and sale forecast company template. This is designed for a company that's maybe more just starting up or a little bit more simpler in nature or less complex. And I'll explain a little bit more what that means. There are some companies that would need a little bit more of an elaborate budgeting spreadsheet just because they have a few more things going on. But for a simpler business that's just looking to maybe have a sales target to know what its sales goal should be, and to have an idea about maybe how many number of jobs they need and what the average transaction size needs to be for each one of those jobs to break even or achieve their desired level of profitability, this spreadsheet is really designed just to kind of focus on those three variables again, which are sales, the number of jobs they need, and then the average transaction size they need among those jobs to hit their sales targets. For certain companies that have a larger sales funnel, like leads and conversion rates, and how many people they're actually talking to of their leads, and how many they're actually closing. And for some that have more in accounts receivable, accounts payable, inventory, have a maybe expenses by department, or just a lot more of expenses in nature because the company is more mature, that just has more moving parts. Then a more elaborate spreadsheet would be designed to take into account all of those variables. But this one's a little bit more simple in nature, just to focus on those three that we just mentioned. So to kind of give you an overview of how this spreadsheet is laid out, to give you an idea, so you're going to see some descriptions here along the left. Main thing down here, you can see this is projected sales. These are our cost of goods sold, our gross profit, and then certain operating expenses we have, and I'll come back to these in a minute. Then what you can see is we have a couple different options or scenarios that you can take into consideration. So we have option 1 here. That's where I'm also going to kind of just run through our sample little case, this little what if case we have here. Or this could be your conservative projections or budgets or forecasting. This is option 2. Maybe it's more of a moderate business as usual, what's average, maybe more what's expected. Option 3 could be, maybe more aggressive. If you're really optimistic, what might you hit. There's an option 4 here, which is what your actual results are, year to date, whether it's 3 months in or 6 months in. And then there's this option 5, which is maybe reforecasting or annualizing. If you got, for instance, the first 6 months of the year in here, and you're going to reforecast out for the back 6 months of the year, or for the entire 12 months, you're kind of reforecasting based on where you think things might land. Again, these are really just 5 different scenarios or columns you can use for any different scenarios. The other thing is, you can retype in here, what you want accordingly, and so forth. So if you want to rename those for something that you think is more relevant to you and your business, or how you want to think about it, you can do that. The other thing is, when you get this spreadsheet, we will have it protected so that any of the formulas, for instance, like here, this is going to add up your total sales columns. This is going to add up what's your sales minus your cost of sales. So there's certain cells in here that are formula based. So we will have those protected, so you're not going to be able to override those formulas. You can obviously unprotect it through some of this, if you know how to use Excel. But just make sure then you don't adjust any particular cell that might have a formula in it. But the other way that we kept that simple for you is that any of the cells in green is where the money is. These are the cells that you'll be able to input numbers into, and the ones you'll actually be able to select. Now, a real quick note, some of the descriptions here we didn't make all green just because we didn't want green to be dominating the spreadsheet, but you'll be able to adjust all of these descriptions here as well if you want. And also this area over in the comments area over here, you'll be able to adjust these too. And also then put any notes that you might have, and like this is a note, for instance, we'll come back to when we get there. But so generally speaking, again, any of these descriptions over on this left-hand side column here, these comments, you can write in there even though they're not green. But when it comes to the actual budget numbers, these are where you'll want to input certain numbers, because then, for instance, this number would be the output of everything in here that's green, like total sales. So that's just a little bit overview on how the spreadsheet works. So let's just say, for instance, to start, someone wanted to project or have a goal that their sales were going to be 100,000. So they'd put sales 100,000 here, and maybe you'd put like another description to be a little bit more elaborate what kind of sales that might be. But then the other thing is, let's just say they knew roughly their cost of goods sold, which are their direct costs to go into producing their product or service, meaning that without these expenses, they wouldn't have sales. So, for instance, if you're a restaurant, you don't have food cost unless you have sales. I mean, I guess you could order a lot of food and you just never sell it, but that's a little bit different. But the main bottom line is these are the expenses you have to generate sales. So, for instance, if you're a retail shop, you obviously have to have inventory. The cost of those goods sold, is obviously an expense you have to have that generates sales. So in a restaurant, it's the same thing. So this would be like the food cost, for example. So you can see here their cost of sales is about 35% of their sales because they're 35,000 divided by 100,000. Now, generally speaking, for a business, their cost of goods sold, their cost of sales, should increase proportionally or decrease proportionally with sales equally. If their gross profit's going down a lot as sales are going up, it might be a sign that they're not able to control their cost as their sales grow, either because of what it takes to process it, to produce it, the materials or the labor that go in it, maybe that relationship of expenses to revenue or expenses to sales changing. But it's always something that needs to be paid attention to because your gross profit's very important because it's what's left over to cover any of the overhead or operating expenses that you have. And then we're just keeping this very simple here. So for instance, a business might have, some rent of $2,000 a month, or maybe it even knows a place that it can rent, free for the first 12 months because it's somebody that they know and they're going to kind of let them use the space. So maybe even for the first 12 months of the year, and they're not going to have any rent, but they'll still likely have utilities and supplies, maybe some vehicle and mileage in there, office expense, some advertising, legal and professional for their tax returns, maybe talking to an attorney to draft a few documents for them. They might have insurance in there of, let's say, $800 a year, licenses of about $300, and maybe, travel and entertainment of about $500. But these are just some of the additional expenses they might want to list out. And again, these are operating expenses or indirect expenses because they're expenses that we have regardless if we produce sales or not. If generally speaking with rent, if you're closed on a Sunday, you still have rent expense related to that. So these are the expenses you'd have regardless of whether you're producing any sales or not. So this is kind of just a brief budget, based on having a sales target, what we're estimating our cost of goods sold at, which is also, by the way, you see here plugged to 35% because in this case we're assuming their cost of sales, or like again if it's maybe a restaurant or something, we're assuming that cost is going to be 35% of sales. So we're just going to plug in 35,000 for that. And then there's just some of the other miscellaneous brief operating expenses that we're going to plug in there. So you can see here that after sales of 100,000, cost of sales of 35, and some of these operating expenses that we have about 55,400 in net income left. So that would be the profits left over for the owner. Now, what we also have then up here, kind of just briefly to help with this, is we do have a break even. So what this means is that a sales volume of 14,769, they will be able to break even, meaning they'd have zero profit, zero loss. So actually, just to kind of demonstrate that for you for a second, and I'm just going to put a formula here in this cell. So if I say this cost of sales is this sales number times the 35%, this will be, oops, let me just redo that again, times 35%. Oopsies, hold on. Sorry for a moment. Let me so if I take this times 0.35, right, it's going to get 35,000. So for instance, if I drop this sales then to 14,769, notice all of a sudden how my cost of sales goes to 5,169, and notice that this percentage is still 35%. Do we know that formula is calculating right, which is again this sales number times the 0.35. And then what we can see is that they got 97,600 in operating expenses, and you can see the net income per books is 0. So that means we're breaking even at that point. Now, also keep in mind that once they produce above this break even, it means that anything over and above that break even is going to flow straight to the bottom line, because this break even formula is taking into consideration what we need to sell to cover all of our operating expenses based on how much our cost of sales is. So for instance, they get to keep 65% of every dollar that's left over after their cost of goods sold. That 65% has to cover these operating expenses. So by the time they paid for the goods they needed to produce these sales, and then had enough left over to pay for their operating expenses, they would have needed the $14,769 to break even. Now, if we put this $30,000 in here that we see profit to build into our break even, you can see their new break even point with a built-in profit is $60,923. And just to kind of show you that if they put $60,923 here, notice now the cost of goods sold goes to $21,323. Again, it's that same 35%. They got their $9,600 in operating expenses here, and notice their net income per books is $30,000. Now, also, again, remember that any of the sales over and above this $14,769, because at this amount they'll have covered all their operating expenses, but then for every dollar of sales above that, the first 35 cents goes to their cost of goods sold, this number, and then the leftover is what flows to the bottom line there. So that's just stating that, again, that their new break even with the built-in profit of $30,000 would be the $60,923. Then to kind of just be a little bit more specific in narrowing in on just some targets for goal setting is, if we said this business had an anticipated number of jobs, or let's say they had an actual of 50 jobs, they had an average transaction size to break even would be $295, meaning at 50 jobs at $205 and an average of $295 a piece, they would produce that sales volume of $14,769 in order to break even. Because just to show you, the 50 times this 295 is going to be that, you can see some decimals there. Let me just reformat so you can see that a little bit more clear. But you can see again, you should easily see that 14,769 equals that there. Now on the other side though, if they had to hit their break-even target with some built-in profit of the $60,923, at 50 jobs, they would need an average transaction size of $1,128. So obviously, they had a massive difference in sales there of about, about $45,000. So obviously, if they still have the same amount of jobs at 50 with $45,000 more in sales, they're obviously going to have a lot higher average transaction size to hit that sales goal. But the other nice thing about this, let's just say you want to change this to 100 jobs, then you can see all these numbers shift, and in order to break even, then they need about 100 jobs at an average of $148 a piece, or they need 100 jobs at an average of $609 a piece to hit their new break-even target of $60,923, which would cover all their operating expenses, cover their food cost, and build in a profit for them of $30,000. So again, this is for instance, if you want to, let's just say hit that sales target of 100,000, and let's just say you're going to have 100 jobs in this case, then again, yep. So let's just say, again, you'd have to, again, average transactions of $148 if you had an average of 100 jobs during the year, and you'd have to have about $609 in the average transaction size at 100 jobs to hit that desired break even. The other thing, though, that you can kind of just see is that if they did have sales of 100 and cost of goods sold of $35,000, and then they did have these operating expenses here, you could also see then that their net income per books is about $55,400, which is what they'd have left remaining after that. So that I might have had a little bit of duplication, repeating myself there in the last minute or two. I think you were able to probably follow that. And again, this just kind of gives you an overview of this spreadsheet and how to use it. If you have any questions, you can just give us a call. But we tried to make this simple. And again, you're just gonna the green cells are really where you're gonna plug stuff in. Again, you can change any of these descriptions on the side that you want, or over in this common areas. And the worksheet will be protected, so you can't accidentally change any of the formulas. If for some reason you need it unprotected or make some modifications, you can let us know. And again, also you kind of have these 5 different columns for these 5 different options or scenarios or what if scenarios you can run. But this just kind of gives you a good template to establish the sales target. How many jobs do you need, and at what average transaction size do you need in order to break even, achieve your level possibility, or based on whatever your specific sales target is. So, hope you found it helpful, and let us know if you have any questions.